Hi, fellow traders, and welcome to the 9th edition of how to really grow a small trading account. And today we're going to talk about, or we talked about overexposure to the market, or preventing overexposure to the market. Again, these are recorded in chat. This is what I do every Wednesday for all of our members, and I decided to share this series with you guys and put it on YouTube so you could see the recordings, because I think it's very important for everybody to really know what you really need to do. You get sold dreams and hopes and everything, but you don't really get taught the reality of trading, the real day in and day out of a day trader. So and this is what I'm trying to share with you, and I'm trying to share the things that you really need to think about as you are trying to grow your account. So today's video again is dealing with preventing overexposure to the market. So real quick, I want to invite you, if you haven't already joined us, to spend some time with us in the fourth quarter. We're looking to finish the fourth quarter strong. If the first three quarters didn't get you where you wanted to be, we're having a renewed focus. You can check out the video that's on YouTube where I'm talking about finishing the fourth quarter strong. So just jump on over to averagejoetrader.com and you'll see what specials we're offering for the fourth quarter. I'm going to be in chat every day. I'm trading a small account. I actually reset it beginning of this week. Whatever I make up until the end of this month, I'll pull out and we'll start over again. But I'm just going through a little trader rehab here. If you're in the room, you know what I'm talking about. But I'm up 26% from Monday and Tuesday. Today I stayed out because I really didn't get a good feel for the market. I didn't like the price action I saw. Plus the two stocks that really made good moves were a little bit out of my price range right now. So unfortunately I reset a couple weeks early and I couldn't trade these winners, but that's the way it is, and you can't let that bother you. You just keep on trucking. So if you want to check it out, just go over to the website, or if you want to email me, if you want to ask me any questions, ed@averagejoetrader.com, or if you want to talk or chat about it, feel free to let me know. I don't mind talking. I love talking. So just check me out. Wanted to send you that invitation. All right, so let's get to the video from today. Yeah, it was great sitting back watching. Some people weren't patient. Some people were. Some people just kept trying until they hit it. But at least you learned. If you were paper trading, at least you were able to see and look at the price action and know that these are the days where you really need to be cautious. If you want to trade and you want to try it, do it with smaller size until the market kind of settles in and you start to see a stock that's going to pick a trend. But we had two. I think WDC was a good opening range breakdown, and then we had a bounce off the level, and then ALNY was an awesome opening range breakout, and then we got and it just kept going. But unfortunately, I probably would have been working those stocks if I had my normal size account. But being that I reset this week, I couldn't really maximize it. But ALNY would have been an awesome trade with just 50 shares. But didn't see that coming. Based on what I was seeing in pre-market and what I was feeling, I just didn't see it coming, but it happened. So it turned out to be a pretty good day for a lot of you guys. So I am happy. So today, we're going to talk about preventing overexposure to the market, and this is critical when you're trying to grow a small account. You can't risk overexposing yourself, because you put yourself out there, and you're hoping good things happen. And like I said before, hope is not a tactic. So you got to make sure that you don't overexpose yourself. So we're going to talk a little bit about that today. So exposure to the market, we usually refer to that, or overexposure is usually refers to you taking on more than you can afford to lose. That means you're overly exposed. You are maxed out on your margin. You may have $2,000, but you've got an $11,900 position. And in that respect, you're overexposed. And a lot of times you're not prepared to take the losses that can occur with that. So overexposure, it can indicate that you purchased too many shares at one time, and you're not really used to the swings or the rhythm of the stock. You're just either following somebody in, trying to mirror somebody's trades, and you really don't understand how to manage your loss, how to manage your risk. And your timing is not there. Or like today, when the market was just uncertain, and for me, I wasn't comfortable. And had I gone in, I could have probably felt overexposed, and that creates some psychological aspects, and then we're going down a whole nother road here. So we want to make sure that we understand what we're getting into, and that we're not overexposing ourselves, because we do have a small account. We're trying to grow it fast as we can, but we've got to be smart about it. And and that's where this concept comes in. Now, if for some reason you guys lose me, we've got a storm coming through. It's just raining real hard now, but I did get an alert saying there was lightning in our area. So if the wind blows hard, we lose power. I'm not in the upscale neighborhood, so we're the last people on the totem pole. We get the leftover stuff. So if just in case, that's just want to let you know that's what happened, and I'll be trying to get right back to you. All right, so think about this. If you've been trading one stock all day, you kind of got in this rhythm. Like some of you guys that were trading ALNY today, you kind of got into its rhythm after a while. WDC, you kind of got into its rhythm after a while. And if you were watching BBY or BBBY, then you could not really get a rhythm. All you could see, it was just chopping around. It was over VWAP, under VWAP, over VWAP, under VWAP. And it wasn't until we got under it and we rejected it that I felt that it had some rhythm and it had a good chance to, test the 2260s, 2250 level, 2260. And, that's what happened. And that's where understanding and really getting a feel for the rhythm of the stock. And that's what I try to do pre-market. I try to get the rhythm of the stock pre-market. And there was a time where I never traded pre-market. I stayed away because it was just too risky. But this past year, the setups have been coming in. You've got more people trading pre-market. We've got more volume in it. And the setups have actually been a lot cleaner. So I've been taking more trades pre-market. And as long as the opportunity is there, I'm going to take it. And so with BBBY, we were looking at the, I was looking at it pre-market under the VIII. And once we lost it and we confirmed it, real quickly it turned back around. So, getting the rhythm of the stock, once I saw that and I saw how we would go over it, go below it, go over it, go below it, go over it, go below it, I knew that was a stock that that I needed to stay away from. I needed to stay out of. Hey, Jay-Z, just expand the whole screen. Up at the top right. I mean, not top right. Up at the top left. Click on full screen. You have to scroll sideways. Does everybody else have to scroll sideways too? If they click on the full, if you click on, up here, I think it's on the top left. Yeah, click fit to screen. Yeah, because there's a way you can get the whole thing. Click fit to screen and then make it, and then click full. See if that's going to work. That's got it? Okay, great. Great, 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 great. Alright, I guess I should have shared that with y'all 6-7 months ago, huh? That might have been good to know in January. Alright, so let's say, we're trading this stock. We got its rhythm, we understand what's going on, and we've been trading 100 shares, okay? And we've been nailing this thing. And then all of a sudden, you're like, you know what? I'm going to go in with 300 shares. I'm going to double my position, or I'm going to triple my position, because this thing is working so good. At that point, you change pretty much everything that you've been doing. Because when you change your share size, you change your risk parameters, and you're going to have to not give it as much room as you have been with 100 shares. And so that's going to cause you to lose your timing and lose your feel of that stock because you have overexposed yourself. So that's something that you never want to do. If you start trading with 100 shares, just continue with that. Even if this thing sets up and it looks like a monster, what's going to happen is you're going to lose your rhythm. You're going to lose the feel because now you're in 3 times the size You can't give it the room, and you bring in a whole host of other emotions. So, that's a form of overexposure. Okay, and that's where, more than just simple financial overexposure comes in. You're starting this psychological thing. We're establishing a solid foundation here. We're trying to build a solid foundation that you can start small, and you can grow your account, in increments. And as you do, you're developing your skill, you're developing your foundation that you could always come back to when you lose your way. And I just demonstrated that this past week. Last week, I was just losing it. I don't know what took over, but I knew I could come back to my safe place. And in 2 days, I've grown my account 26%, Monday and Tuesday. And I know 26% of $1,300 is not a whole lot, but a whole lot of money numerically wise. But for account growth, how many of you would be happy growing your account by 26% a week right now? Because you're losing money every week. How many people will be happy just to grow their account by 26%? And it's very, very possible. It is 100% possible to do that, and do it with a $1,000 account, with a $1,500 account, with a $2,000 account. But I'm up a little over $300, and I started Monday morning with $1,200. So it can be done, but you have to get the huge numbers out of your head. You can't think about the numbers. You have to think about the trade. Think about learning the skill. Learning the setup, learning the strategies, developing the discipline to stick to your plan, and making sure that you're not overexposing yourself and creating this mental monster that can destroy you. And it's, to move away from this, especially in the middle of the day, you shouldn't be doing that. I honestly say you have to look at the day in sessions. The morning session for me is from 8 o'clock to 10:30. Then we've got lunch. For me, the lunch session is from 11:30 to 12:45, because 12:45 is when you start to see some volume coming back in the market. And from 12:45 to the end of the day, that's another session. So if the morning's not right, you always hear me say, I'm just going to wait till the afternoon. And the afternoon, you shouldn't change anything. If you had a solid morning and you made a lot of money, don't take unnecessary risk by going bigger size in the afternoon, because it'll take you half the time to lose the money that you made in the morning, and then you're really going to be mad at yourself. So stick to your system, and don't stick to the same exposure in the market throughout the day that you start with. Now there's nothing wrong with starting with half size and then moving to your normal full size. That's different. But when you're trading your full size and then you double or triple, and you normally don't do that, then that's going to create a problem. And most people don't think about that. They think about, if I triple this, I'm going to get triple my money. So instead of making $150, I'm going to make $450. Well, guess what? You won't make $150. You might lose $450 because you may lose 3 times what you thought you were going to win or that you were going to make, and it's not worth it. All right, so we talked a little bit about time and timing and understanding, timing your entries and your exits and all of that stuff is one thing. But, time has a couple different applications. So when you're thinking of time as far as experience, you can deal with overexposure because you gained that familiarity. You are comfortable trading the size that you normally trade. And when it was scary at one time, now you're safe. You're feeling confident and you're happy with where things are going. That's when you are the most dangerous, believe it or not. Because you think you can do no wrong anymore. And the reason why I know that is because I have bouts of that myself, thinking I can't do no wrong. But in trading, you're gonna be wrong. You're never gonna be right 100% of the time. You're shooting to be right 65-70% of the time. If you do that, you're on point. So we look at time as how much time we spend in the market, what kind of experience we have, how much time we spend, reading price action, reading charts, doing paper trading. But then when we think of the market time, we're talking about time a day. Different points in the day that you can expose yourself to more risk. And that's what I was, talking about a minute ago. We're bringing it in now where, is it more risky to size up in the afternoon than it is in the morning? Or is it more risky in the morning than it is in the afternoon? It really depends on your strategy. If I'm trading the opening range, breakout or breakdown, and then I'm trading the secondary trend continuation trade, it's going to be less risky for me in the morning. In the afternoon, the volume is going to be a little bit lower. The stock's going to move a little slower. So there's going to be a little bit more risk involved because things could be going real slow, then all of a sudden it takes off against you because the volume is lower and the stock is not really moving, and somebody with big size can come in and just put a wrench in everything. So you want to think about the day in segments. I put pre-market. I used to have pre-market, then the open, then lunch, then the afternoon session, and then aftermarket. But lately, for the last several months, I'm putting pre-market and the open together. I'm looking at that as one segment because it's been kind of a seamless flow from pre-market to the open. And I'm looking at it that way. But you have to look at the market in different time segments because that's going to determine your risk parameters. So for me, I like to size down in the afternoon. I'll have size in the morning. In the afternoon, I like to size down. Unless we had days like today and, had I traded this WDC or ALNY, I would have done it with probably half size because of what I was seeing in the market with a lot of these stocks. So understanding the different times in the market is going to be key. And again, trading pre-market and aftermarket has its benefits. Aftermarket for me is a lot more risky because I'm guessing based on research, and sometimes I guess wrong. But I'm still, as long as I'm guessing right 70%, 60%, 70% of the time, I'm going to be fine. But it's very risky. Pre-market is not as risky as it was before, but I'm more experienced trader. So when you get experience trading a certain strategy, you want to make sure you can do it intraday before you start trying to do it pre-market, because you're going to have to recognize something a little bit quicker pre-market than you would during the day. Because pre-market, the volume is lower, things can turn on a dime. And you got to see it coming. Sometimes you can't see it coming. But you want to learn to try to find out and to see whether you've got a change in momentum coming. You've got to pay attention to that. But, you could lose a heck of a lot of money, trading pre-market and aftermarket too, because you can't put in a stop order. You can only use limit orders. And if you don't use hotkeys, like I don't use hotkeys, then you may run into some trouble trying to get out of a position that runs against you. You don't have that market button to save you, and you don't have those stops to really save you. So you want to make sure that you're real comfortable with your strategies and what you're doing. So even, and I'm guilty of this too, because a lot of this stuff I'm sharing with you guys, I'm guilty of it. Holding past your exit price. I'm overexposing myself. And when you do that, you're exposing yourself to the market when you shouldn't be. You should be out. Like Flavio, you should be out swimming in champagne when you make this money, instead of holding it, trying to see if you can get a couple more bucks. And it usually bites me when I try to do that. I'm going to make some money, but I'm not making as much as I could have if I wasn't overly greedy. You got to have some greed, because if you don't, you probably won't trade. You'll just take $25 here and $25 there. So you got to have a little bit of greed. But, when you ignore your plan, you're no longer trading the plan. You're going rogue. And when you go rogue, things start to go wrong for you. Yes, you should respect the targets. Definitely, you should respect the targets. When you don't, that's what I'm saying here. When you don't respect those targets, you're overexposing yourself again. And you don't really need to. You've already made money, just lock it in. And if it sets up for you to get back in, get back in. But, you don't want to lose your rhythm, lose your momentum. Like I said, trading is a momentum game. And once you lose your momentum, it's going to be hard to get it back. And it's easy, a lot easier for your momentum to go to the downside than it is to go to the upside. Just like stocks. It's a lot easier for a stock to go down than it is to go up. So, our momentum can do the same thing, and we have to protect that. This is another important point, why I say you need to set max losses per trade. You have to get accustomed to making or losing certain amounts of money on each trade. If you're trading small, like if you're starting where I'm starting, I went from $100 max loss now to a $50 max loss. Okay, that's the max I'm gonna lose on a trade. So when I put my stop out, I'm only gonna lose $50. So that's all I'm gonna give up. So I have to put the position size in so that I can allow myself enough room to let the trade work. And on the flip side, you have to get used to hitting your profits. Okay, if your first cover, if you're trading small and your first cover is $50, you got to be okay with that. Because if your first cover is 50 and then your second cover is going to allow you to make, let's say, $75, that's $125. But if it doesn't follow through, you still want to lock in that 50 and you want to get used to that. You don't want to let the trade continue to stay on past break even because you think it's going to come back or you want to make that whole money. No, you can't do that. So you've got to you've got to stick to your plan. And if you haven't, if you've done it already, if you've not stuck to your plan and you've lost, then you know exactly what I'm talking about. And I think that's one of the beautiful things about what I do in chat. It may, I may look like a complete jackass sometimes, but that's real life trading. You've got traders that's been in the game 30, 40 years that make complete jackasses out of themselves all the time. I mean, it's reality. And, you guys have to see that. And you have to see how to respond, when you put that jackass head on. It's just like, I feel like I've got the donkey suit on and everybody has these pins and they're trying to pin the tail on me. And every time those pins stick my behind, it feels like I'm getting shocked. You don't want to go through that feeling. So selling your profit short, I know sometimes it sounds counterproductive, but you have to stick to your plan. You have to take profit when you see the momentum shifting. You got to take it. Because if you don't, and you don't stick to what you see and what you feel, you're going to end up giving money back. Giving money away that you don't need to give away. All right, so when you trade smartly, you're only exposed to the market risk that you provided for yourself, that you can handle. For instance, if you know that you're going to sell at a loss when the price hits a certain level, then all the risk that you're exposed to is the amount that you prepared yourself for in the event that the price goes against you. So if the trade goes against you, you have a hard stop in at $50, and that's all you're going to lose. And that takes a lot of that emotional baggage you have off of you. Hang on one second. Somebody's ringing my doorbell. All right, so I've got 3 principles that I use to avoid overexposure. Okay, first, you got to say I'll pass. There are times where you have to pass up on a trade. If you have to give yourself too much room and overexpose yourself or put too much money in a trade, then you're going to have to say, I'll pass. Who is it?
I think it's Jamie.
Huh?
I think it's Jamie's car.
Oh, okay. Also, plan. If you don't have a plan, you don't trade it. If somebody calls out, let's say somebody called out ALNY, and they're like, "Oh man, I like this. This is setting up," and you just jump in it, and you don't really have a plan as to what strategy you're trading or anything. You don't have anything set. So don't take the trade. You have to be disciplined enough not to take it. Just watch it. Watch it and see what the stock does.
It's gotta be, I think.
Let her know I'm doing it. Here. Also, you don't need to be perfect. Okay? You don't. Why? This isn't a perfection thing. You're going to make mistakes. Things are not going to go the way you want to. So you have to not worry about, being perfect. So when you say I'll pass, sometimes you have to pass up on good to get the great. Sometimes there may be a good setup you see, and you have to pass it up. It's not great. You need to wait for the great setup. So not every trade opportunity is for you. You have to stick with what works for you. Okay, if you want to change something up, if things are not going the way you want them to go, or your strategy seems to not be working out that well, and you want to make some changes, then that needs to be done in the simulator. You don't just change in the middle and sit here and start playing with your money. That has to be changed in the simulator. So you have to stick with what works for you, and know that not every trade that you see is going to work for you. All right, and again, no plan, no trade. You got to have a plan in place. If you don't take it. Don't follow anybody. Don't follow me unless you know exactly what you're going to do when you get in. So I always say begin with the end in mind. You need to know where your stop's going to be before you enter a trade. If you enter a trade and the logical stop is going to be 70, 80 cents away, then you probably don't need to take that trade, or you need to go in with enough size that's going to allow you to give yourself that stop. So before you take the trade, you have to make sure that your stop is going to make sense. If not, how many times do you guys get stopped out and then the trade works? Now think about how many times that happens. So if you don't begin thinking about where your stop's going to be or where you have to place it, then you're going to get stopped out too many times. So you have to look at, technically look at the chart, say, okay, my stop has to be here. I've got to stay within the dollar amount, the max loss. But my stop needs to be this far away. Can I logically take this trade? If you can't, then you stay out of it. That keeps you from getting stopped out. And that keeps you from trading too many, having too many tickets, running up your commission costs, and it keeps you from getting stopped out. And that's something that we're going to be focusing on too, more often in chat. The focus in the fourth quarter is going to be making sure that we stick to our rules and that we stick to our plans and we stick to our risk parameters. And again, don't have to be perfect. Don't try to top tick and bottom tick every trade. When you do that, things don't work out that well. Just try to catch the meat of the move. You hear me say that all the time. Try to catch the meat of the move. All right, so lastly, self-discipline means avoiding the consequences of overexposure. We have to be disciplined. And we say that over and over and over again. The key to avoiding overexposure is first take the time to create consistency in low exposure environments. Translation, trade small size. Or trade in the simulator. But when you trade in the simulator, make sure you do that. You trade with the same size account that you will be trading when you first start trading live. Because if you don't, it's not going to work out well for you. Avoid trading pre-market or aftermarket until you're consistently profitable during the regular trading hours. If you're not profitable then, you probably aren't going to be pre-market or aftermarket. It's just going to be worse. So whenever you're feeling completely lost or out of control, you're not in control of the trade, more than likely you're overexposed, so you need to stop out. Close everything out, stop, and then gather yourself again. These are the things that you guys are going to have to do. Especially when you're trying to grow a small account. These are the things that you're going to have to focus on. Everything that I've been sharing over the last 8 or 9 classes, those are the things that you're going to have to focus on. All right, so does anybody have any questions? All right, I see 5 or 6 people talking. Let's see. Yeah, that's going to happen every day. Rodney, I don't have a momentum scanner, and that's something that I'm looking at adding, but I don't trade, stocks like that. I like to find a stock in the morning and, like ALNY, and then like the stock Monday and Tuesday that I could trade all day. And once I get locked in, I can continue to do it. And there are going to be stocks that pop up in the middle of the day that's going to have breaking news, that, something happens or somebody gets interested in it and it moves. That's always going to happen. But you have to you got to filter out all that noise. Once you have the stocks that you're going to trade, you have your watch list, made so that it reflects your strategies, then you don't want to go chasing. And when you go chasing other stocks, that's when things go badly for you. Julian, with the technical stops, what you need to do is, what I like to do is make sure that it closes above that level and then it claims it. So sometimes if I'm using a 20 moving average as my technical stop and a candle closes above it, then I wait for the next candle to close. And if that candle is having trouble moving up and it can't make a new high, then I'm going to stay in until it is proved to me that it's claiming the technical level, unless it just goes up and hits my max loss. But you have to let it test that technical level. And what's happening lately is there's a lot of fake outs, and that's just the way the market has been, because a lot of these traders, a lot of the institutional traders and the ones that have these automated trading systems, they do that. They'll make the stock go above or below, bait people in, and then let it go where it wants to go, or get people out, and then it does what it's supposed to do. So you kind of give it a little, you got to give it a little time and watch the price action. And it all comes with experience. The more you do it, the more price action you experience, the better you're going to be at doing this and knowing when to get out, when to get in. No, it's a feel. It's that timing. It's getting the rhythm of the stock. But you can't second guess yourself. On stocks where I get out and they end up working, like yesterday, you can't really second guess yourself at that time. I went back last night, and when I did my reflection, I realized I had no reason to sell it. So all I did was sell myself short. But if you do it during the day and the stock ends up making the move you want to, don't worry about it then. Wait till the night, because if you let it get in your head, it's going to cause you to make more mistakes. Yeah, the reversal scanners are awesome. But again, the market has to be receptive to it. The market has to have some direction for the reversals to really make full moves. A lot of them will make the first move and then that's it. It averages the price. Dustin, it'll average it. It doesn't weight it. It averages it, and then it factors your win and your profit or loss based on how many shares you have at the average price. All right, glad I explained that good enough. All right, bye-bye. Any more questions? All right, you're welcome.